It was nice to see everyone that was able to attend in person at our December meeting. And unfortunately, we had to go back to Zoom meetings again now instead of the in-person meetings. But the good news is too, we've had about 147 registrants for the program today. So it's good that everyone was able to get up this early, and we want to thank our speakers for getting up this early as well too. I just wanted to remind everyone about the membership attendance requirements and the dues. Regular members, again, are required to attend 2 annual meetings or 2 meetings during the fiscal year, and the fiscal year runs through June 30th of 2022. So if you haven't, this is the first meeting you've attended, make sure you attend at least 1 more to keep up your regular membership. And if you haven't paid your dues yet, please do so as soon as possible. I want to thank our 2022 sponsors. They're on the screen, but there's 5 platinum sponsors that I want to mention by name. Best Times Financial Planning, Inc., Mapstone Veritas, Tompkins Financial Advisors, Welker, Moshe and Delvecchio, and Woods, Oviatt, Gilman, LLP. We also have a number of gold and silver sponsors that will be flashing on the screen from time to time. If your company would like to be a 2022 gold or silver sponsor, please contact either the EPC office or the communications chair, Vicki Kleehammer at EFPR Group. I want to remind everyone to fill out the speaker evaluation form, either online as part of the CE credit process. That also helps with upcoming programs. And if you've got an idea for an upcoming program, the program committee would love to hear it. And please put that on the evaluation form as well. For the attorneys in the audience, just want to remind everyone about the CLE credit. There's going to be 2 code numbers during the presentation, and you need to add those code numbers to the speaker evaluation form in order to earn CLE credit. Our speakers are going to be announcing the codes during the presentation. So listen carefully. They're just going to be announced at the one time during the presentation. Also, attorneys have to turn in the CLE board's revised attorney affirmation form, and that's available on the epcrochester.org website. I want to thank Elizabeth Thorley, our program committee chair, for coordinating the programs this year, and also Jamie Block, who was organizing this particular program. And now I'm going to turn this over to Elizabeth Thorley.
Morning, everyone. Just a couple of announcements and reminders. If you have missed some of the past programs, we are keeping a video of any of the Zoom meetings on the website, our local website. So you can find that under membership in the subfolder of videos. Also, if you're looking for handouts, they're posted to the main page of the website, in addition to being emailed and a link to you before this meeting. But I know there's always people that want to look at the material after meetings, so we're making sure that that's available to you. Please mark your calendar for some upcoming events. Our March meeting on the Tuesday, the 29th, Planning Needs for Individuals with Disabilities, Supplemental Needs Trust and ABLE accounts, will be presented by James Traylor and Nicholas Prokow. Probably messed up his name, so I apologize in advance. That will be a morning session, again, March 29th. We are planning to hold that virtual at this point. We are hoping to hold the May meeting as a hybrid like we did in December. So we will do a Zoom and in person. The location and date is to be determined. We have changed our plans and will be deferring our talk on changes to tax and estate laws to later in the year. That program will be in September. Also, on the 28th of July, we will be holding a joint meeting with the Jewish Foundation, and the speaker for that event is going to be Jeffrey Levine. He's from Buckingham Strategic Wealth, and he is part of the nerd group of Kiddish and Company. So I think it'll be a very entertaining and worthwhile event. That's July 28th. And then finally, I would encourage you, if you haven't participated in some of the national webinars, the National Association of State Planning Councils. All of their events are listed on our website, or you can go direct to the national site. They have some great worthwhile programming, and that's probably a good segue into today's presentation. So I'm going to hand it over to Jamie, and thank you all for attending this morning.
Thank you very much, Elizabeth, for all your hard work on programming. I'm now going to introduce our speakers. So we have Steve Parrish, and he's the co-director of the Center for Retirement Income at the American College of Financial Services, where he also serves as an adjunct professor of advanced planning. He is also an adjunct professor of estate planning at Drake University Law School. With over 40 years experience as an attorney and financial planner, Parrish frequently addresses the financial challenges of individuals, business owners, and executives nationwide. Parrish is an expert on retirement, estate, and business owner succession planning. He is a recognized industry authority, spokesperson, and author, serving as an ongoing contributor for Forbes.com and the Kiplinger Wealth Creation channel. Parrish has served as an expert source for such prominent media outlets as Investment News, Money.com, Kiplinger Market Watch, Wall Street Journal Radio, the list goes on and on. He's also an associate editor of the Journal of Financial Service Professionals. In addition, he is a sought-after speaker, obviously, because we have him here, with Bar Association, State Planning Councils, and State AICPA meetings. He has addressed such financial service organizations as MDRT, AICPA, and many more. And of course, now the Rochester EPC chapter. Parrish also addresses numerous business organizations nationwide and has served as an expert witness. So we'll have to ask about that later for interesting stories, I'm sure. Co-speaking today, we have Sophia Duffy. She's an Associate Vice President of Curriculum Quality, as well as an Associate Professor of Business Planning at the American College of Financial Services. Duffy teaches in both the Hubner School and the Irwin Graduate School. She began her academic career at the college in 2012 and remains an instructor for a number of classes. In 2015, Duffy was appointed interim chief academic officer, directing all matters relating to the academic unit during the 9-month CAO recruitment and appointment phase. Prior to that, she served as assistant dean of business affairs with overall responsibility of sourcing and coordinating all academic projects and products for the college, overseeing the examinations department and managing expenditures with the academic affairs department. Wow, that's a lot. Prior to joining the college, Duffy was a senior auditor for several years, providing audit and compliance oversight for PricewaterhouseCoopers, Aramark, and the University of Pennsylvania. She received her Juris Doctorate from the Temple University James E. Beasley School of Law in 2012 and her Bachelor of Science in Accounting from Rutgers University in 2012, and she's a CPA. And the one thing I didn't do was go over their numerous credentials because I want to make sure you all get back to work and I don't take the whole day. So very talented and qualified individual. So I will turn it now over to our presenters. And thank you so much for doing this for us.
Okay. Well, thank you very much, Jamie. After that introduction, what can I say? In conclusion, maybe. It's very nice to be here, and we should explain when we say here. I'm in St. Augustine, Florida, and Sophia is in the Philadelphia area, and Jamie said if I said what the temperature was here that you'd all hang up on me, so I won't even get into that. As you know, today what we're going to talk about, and I thought we'd get right into it, but talk about the Social Security considerations, specifically in estate planning. And I tell you what, it must be a really important topic because we have this disclaimer that basically says that we're not responsible for anything we say. So, gee, it must be important. So what we want to do is tell you why this has become a topic of interest for us in our work at the American College, since you've heard about the fact we're both there. For me, as co-director of the Center of Retirement Income, obviously Social Security is always a big topic for research and writing. But I tell you, in the last 2 years, the estate planning part of it became a much bigger issue because of COVID-19. Just as you've experienced in your practices, people suddenly awakened to the fact that they or a loved one obviously could die unexpectedly. And with that comes a question of, what will I have to live on if something happens to my partner? And suddenly Social Security isn't such a pedestrian topic. And then one other comment. I don't think of Social Security really as a DIY or do-it-yourself concept for many people. In many cases, you really do need an advisor. Let me give you a personal case in point. There's the 5.9% cost of living increase that retirees got last year because of the inflation we had. Well, my wife came to me about a month ago with her Social Security statement. And by the way, she's a CPA. And she says, it's telling me that her benefit is going to go down $64 a month in Social Security payments that's being deposited into our checking account. She said, how's that work? I thought we got a 5.9% raise. Well, the answer is that Medicare Part B and Part D premiums are deducted from Social Security. Well, yeah, Social Security cost of living went up nicely last year, but so did Medicare premiums. And further, because of my income, she's retired, we were hit with the IRMA tax besides. And that's a doubling of the Medicare premium because of our joint income. So in her mind, the reason I'm telling you this story is through no fault of her own, her Social Security is actually going down, not up. And my point in saying that is people really need help. And that's why we wanted to talk about it at an estate planning conference. Well, the other reason this Social Security is as important as an estate planning issue is that it helps consumers make smarter filing decisions, something that's going to be talked about a lot here with Sophia. As a retirement decision, there's that tendency to say, hey, you know, I might as well take Social Security as soon as I can. But when you're looking at it from an estate planning standpoint, the big picture becomes clearer. And now you're thinking, well, wait a minute, if I wait to file for Social Security, my survivor will have a much larger income if I pass early, and it'll be for the entire life. Social Security suddenly gets seen as longevity insurance and the kind that's otherwise real hard to find. So talking about Social Security as an estate planning issue with the client will lead, I think, to smarter planning decisions. So that's why I got into this researching this area. Sophia, what piqued your interest in this topic?
Thanks, Steve. My interest is also on a personal level. As you can imagine, during the pandemic, many of the faculty were having discussions about impact on life insurance policies and premium pricing, life expectancies, how that impacts financial planning. And a few of my colleagues and I started talking about the impact, particularly that this had on women and claiming strategies for women, knowing that, you know, many of the traditional recommendations for Social Security claiming were based on assumptions like the woman may not be earning as much as a man in an opposite sex partnership. The woman may not have participated in the labor force for as long. But we see that recently in the last few decades, those demographics are actually changing. You have more women that are the breadwinners in the home than ever before. In fact, in the United States, 30% of opposite sex households have the woman as the primary earner. And even other things like women are just amassing more wealth and have higher income earnings history than ever before. And other interesting statistics, like in the United States, just over half of the wealth, private wealth held in the US is held by women. And globally, that's 30%. So there's pretty significant numbers, and the trends are actually moving more in favor towards women earning more. We already know that women tend to live longer than men. So all of those factors sort of came together, and we thought maybe we should take a second look at those claiming strategies, particularly for this group of women who have the highest longevity risk, which are women that are earning the most. And we're sort of using the term healthy, wealthy women because they have the longest expected life spans, therefore the greatest longevity risk. So a few of my colleagues and I got together and did a research on what is the actual quantitative impact of delayed claiming for women that are higher earners or have this opposite sex household where one is a higher earner and one is not. So that's sort of how we got interested in this topic.
There we go. So that's kind of our introduction. So to get going with it, I think we have to address the 1,000-pound gorilla issue that there is with Social Security. And that's, will it be there when I retire? It will be there for my spouse when I die. So here's the deal, at least from our perspective. We were waiting for the Social Security Trustees Report to come out. It's supposed to come out by May of every year. And last year it was delayed, and congressmen were demanding it be done. Well, it was all because of COVID-19, and they were trying to update the figures to reflect the obviously massive impact that it has on something like Social Security. Well, what they found is that there was obviously a spike in elderly mortality, and I mean kind of that 75 up range. And they found that unemployment caused a loss in revenue, which affects the revenue side of the equation. As far as interest rates, suddenly we had this nascent inflation coming along, which is kind of interesting because if you look at the period of time since the recession, the Great Recession, we had 3 years where there was a zero cost of living increase in Social Security, but now we suddenly had all these interest rates. So the bottom line is that the trust fund is now projected to deplete by the year 2033. So that's 1 year earlier than the pre-COVID numbers that were being projected. And then also we are in a period now, it started last year, where we actually are in deficit, meaning more is going out to retirees than money is coming in. And that's why you're starting to see the trust fund deplete. And even that may be a little rosy because there's some assumed improvements they made in coming up with these numbers actuarially, some improvements in unemployment rate. Well, that was pre-Omicron. So does that affect it? And then there were some, I thought, somewhat rosy projections as far as birth rates, which can actually help because it adds to the revenue pool. So what you have is the next question is, if it depletes, I want to make sure I got the right one. There we go. So if it depletes, then what? Now, what happens? Because people don't always understand it. It's not that the government says, well, yeah, we just don't have a trust fund, so it's going to come out of the deficit. That's not allowed. And so what has to happen is you have to make an adjustment. Now, it's not like suddenly Social Security stops when the trust fund stops, because you have all the FICA money coming in. Okay, so you will have some money. The theory is, and this has been projected in the trustee report, that if you start paying out of revenue when it depletes in 2033, it's projected that they'll probably be able to pay 76% or so of current benefit levels. Now, how they're going to do that is still a matter of debate, but we know it's going to be some kind of proration where they say, you know, everybody has some kind of proration, you know, 24% or so. Okay, so what's all this mean? Well, where we are is now Congress does have a report from the Social Security Administration. They got it late last year, but they got it, and they know what they're working with. Now, if Congress decides to do something, that's the big if, we might see an increase in employment tax. So, you know, the cap on Social Security is $147,000 for this year. And maybe they increase that, or there's talk about doing it at $400,000. They could change benefits, such as making the full retirement age 70 instead of what it currently is, which is 67 for those people born 1960 or after. Another thing they might do, almost slip in there, is how they do the cost of living indexing. Because you're estate planners, you're familiar with the fact that they use chained CPI now as part of the Tax Cuts and Jobs Act. So for like estate planning, for the estate indexing, they use chained CPI. That could likely have the effect of slower growth of cost of living factors. So where I'm going with that is, planners, maybe a haircut is in order for younger clients. For people like, I'm on Social Security, it's, you know, we vote, and so that's probably not going to change. But for younger ones, you may want to give it a haircut. I'm going to be in a webinar with Ed Slott tomorrow, and the way he says it is, for younger people, just treat Social Security as gravy. So Sophia, why don't you fill us in on some of the socioeconomic factors that you talked about that, you know, really influence the kind of decisions that have to be made here?
Yes, thank you. So the first part of our research, again, the essential question is, how much money do we really realize by delaying claiming particularly for women who have the longest lifespans. So the first sort of set of factors that we looked at were what actually impacts longevity. So from a planner's perspective or an attorney's perspective, we have clients that fall into these categories or these demographics, then we know we're going to be planning for essentially a longer lifespan or expected longer lifespan. The first obvious one being gender. For women, the average life expectancy is 2 years longer than men, going to 87.3. But for, as we'll see, for women that are college educated, that are higher earners, that are healthy, that life expectancy gets pushed out even farther. So again, that longevity risk increases with these demographic changes. And then we have income. So lower mortality rates are associated with higher lifetime earnings. So if you have women that have higher earnings, then we know that they're also going to have longer lifespans. We looked at the research that we found was that when they compared the top 1% of earners to the bottom 1% of earners in each gender category, the lifespans, the differential is pretty significant. For men, that's 14.6 years. For women, that's a little over 10 years. And of course, the quality of life between the top 1% and bottom 1% is pretty stark. So we also looked at the top 10% to bottom 1%. And research shows that even at that rate, we have about a 2-year differential between men and women in that top 1% of earners versus bottom 1%. For Black women, we actually saw that that's 4 years. So they live twice as long compared to white women in the top 10 and bottom 10% of earners. So again, if we have clients that fall into those categories, we know that their life expectancies will be longer. And then, as I mentioned earlier in the presentation, nearly 30% of women in opposite sex households are the primary breadwinners. So that impacts their ability or their claiming strategies because now they have their own Social Security benefits to consider as well as the spouses. And then moving on to the next slide, some more factors that impact longevity are education. College educated individuals tend to have longer lifespans than non-college educated. For women, that's 2 to 3 years longer. And we're seeing recent trends that more and more women are becoming college educated. So we're having more women being pushed into that longer lifespan category. In fact, the percentage of women with 4-year college degrees increased by 11% to 40% of the population between age 26 and 30. So we've got, big group of women there that are in this category. And I thought just this was interesting for women born, or for actually any individual born after 1961, women are more likely to be college educated than men. And then on the last slide here about the factors that impact longevity, employment is also significant here. So labor force participation for women has been increasing in the past several decades. It's increased by 10% for women above age 60 in the past 2 decades. So what that means is that we've got women that are working longer. Their labor force participation is over a longer time span than ever before. So we've again got more earnings history than for women. 30% of women worked in 1950 compared to 71% today, or in 2010, which is the most recent research that we could find there. And then more women are actually earning more by having more sort of professional level jobs. So white collar jobs increased by 22% for women from 1975 to 2010. What do all these numbers mean? Again, is that we've got more women with longer lifespans because they're earning more. They have, they're all falling into these categories where their longevity is increased. But therefore, that's a great outcome, but their longevity risk is also increased. So as planners, we do need to determine how do we make sure that they don't run out of money. And Social Security becomes a very important factor in that because we've got a continuing income stream then for the remainder of their life that's inflation protected. And then the next slide here pulls here. We go to the next one. This is Steve's. We'll go to Steve here for some retirement strategies while the individual is alive, and then I'll come back and look at some estate planning strategies.
Okay, well, as important as everything that Sophia just told you is, I have something even more important. I have the CPE codes. So make sure you write this down. The CPE code is 2295. That's 2295. I get all the important jobs. Okay. So let's talk about, before we get into Sophia really talking about Social Security from a death benefit standpoint, we thought it would just help to talk a little bit about it as a retirement benefit, because that's obviously what it is. And I'm going to do it kind of quickly, but just because maybe as estate planners, you need that quick reminder. Basically, to qualify, you put in at least 10 years, and then Social Security Administration measures your top 35 years of earnings. They adjust it for inflation as you go along, so that works out fine. And they derive a PIA, primary insurance amount, and you get 100% of the PIA at your full retirement age, which, as I mentioned before, is age 67 for those that are born 1960 or before. It's a little earlier for others. You can elect as early as age 62 to take your Social Security benefit, but then you take a permanent cut in benefits, like 30% cut. Now, conversely, you can delay filing for Social Security, and each year's delay increases your benefit by 8%. So at age 70, you max out, and you should definitely take your benefit. Importantly, people don't always realize this, any cost of living increases associated with the benefit are included even if you delay. So the 5.9 is included in the formula even if you held off filing, even though you qualified. Now, people don't appreciate how large the benefit can be. I'll just give you a quick one. Say the wife makes the highest benefit, and I'm thinking of somebody making above the wage cap, typically of $147,000, and files at age 70. Currently, the couple would receive $65,600 per year for life as a couple, $65,000. That's $46,700 for the worker, and then 50% for her spouse as a percentage of the at his full retirement age. After the first one dies, whether it's husband or wife, even if it's the highest benefit earner, the survivor gets $46,700, 100% of the PIA. And all this includes cost of living. So keep in mind, with a married couple, the survivor gets 100% of the higher of the couple's benefits. So it works like a joint and survivor annuity. And my point is, this is real money, even for affluent individuals. Now, the complexity of the system is just staggering. So I'm just going to remind you of a couple highlights, and then we'll move on to talking about Social Security as a death benefit. Two things to keep in mind with married couples is you can no longer file and suspend. So the spouse with the smaller benefit essentially needs to wait for the higher benefit spouse to file if he or she wants to get that spousal 50% retirement benefit. Now, that could be an issue, as Sophia talked about, claiming strategies, because maybe the person's not working is a stay-at-home individual, but oddly, a divorced spouse who was married to the participant at least 10 years, he or she doesn't have to wait for that participant to file. It's just kind of an oddity in the law. Now, what people don't often appreciate is the death benefit aspects of Social Security. Now, I'm not talking about the $255 lump sum death benefit that's paid by the Social Security Administration. I'm talking about the 100% spousal benefit as well as family benefits. So, Sophia, let's start talking about what's going on there.
Great, thank you. So before we get into what Steve mentioned, we're also just going to talk a little bit about that quantitative benefit of delaying. So Steve mentioned that if you delay to age 70, that's where your benefits max out. So we actually, our research focused on what's that amount of money for someone that actually is delaying until age 70 compared to if they start claiming early. So just as a quick review for the death benefit aspects, the importance here is looking at the joint longevity of the couple. So if you've got two earners, you have to choose when to claim for both based on the joint longevity. And again, we looked at opposite sex couples only because the differential is greater than same sex couples, but you'll see that a lot of our outcomes can be applied in both cases. So for surviving spouses, once one spouse passes away, as long as the deceased spouse was claiming benefits at the time, the surviving spouse can claim on the deceased spouse's benefits, as long as it's higher. For non-working spouses, of course, this is very valuable because they may not have their own earnings history. If they do have their own earnings history, they can choose what is the higher benefit. And their dependents can also claim as well. So for minor children, they can claim on some of their parents' benefits if the parent was deceased. This is all subject to a family cap per year, to keep that in mind. And ex-spouses, we've got ex-spouses, surviving spouses, minor children, as well as disabled dependents can all claim on someone's Social Security account. So all of these together will be subject to a maximum family cap per year. And on the next slide here, we'll go into some of those analyses. So if you have two earners or two individuals and a couple, the question is really to claim or not to claim and when to claim, right? If you claim earlier at age 62, when someone first becomes eligible, the benefit is lower, but it's paid over essentially a longer lifespan, a longer expected lifespan, versus claiming later, and age 70 is the maximum time that you can delay. Claiming later will result in a higher monthly benefit, but over a shorter expected lifespan. For women, that's a really important question because we've still got a longer lifespan compared to a man. So the question that we really wanted to figure out is how much money would a woman actually, or the surviving spouse, actually benefit from by delayed claiming? Which strategy is the best? When we ran the analyses, we used a low interest rate environment, but we also ran some alternate scenarios where we increased the interest rate just to see how those numbers would play out. And we also looked at this bucket of healthy, wealthy individuals compared to individuals of average health. So healthy, wealthy, we're going to assume the longest sort of lifespan that we can assume versus a person of average health where we're looking at more a shorter life expectancy. And what we found is when planning as a couple, generally the higher earning spouses should claim last, meaning they should delay as long as, again, they're healthy. They should delay so that you result in getting a higher benefit later on. Your monthly benefit is higher. And what we found then, that question again being, oh yeah, you can go to the next one, Steve, sorry. So what we found is that most women actually end up claiming at 62 when they first become eligible. 2/3 of women claim as soon as they become eligible, but that is actually not in their best interest financially, particularly if both spouses have earnings history. We found is by delaying claiming to age 70, women in this healthy, wealthy group, and in fact, the higher earners ended up with a gain of almost $180,000 over their remaining life expectancy. And even for women of average health, that gain was over $130,000 over their average life expectancy. So this is, as Steve mentioned, not small potatoes. This is a very significant amount of money that can be gained just by delaying that claiming by 8 years from age 62 to age 70. And the gain also was evident for men. So we didn't just look at women, we also found that for men, but for men, because of the shorter life expectancies, those numbers were about half of what they were for women, still significant. And, it's a little counterintuitive. Some people think, well, why wouldn't I claim earlier? Because I'm getting payments over a longer period of time. But that increase in the monthly benefit is so significant. And for women, they still have a longer life expectancy. So that gain ended up being quite significant for them. Now, on the next slide, we also ran some alternate scenarios. We increased the interest rate by 2%. So I think we were using somewhere maybe about a 2% interest rate. We increased that up to 4%. And we also assumed that starting in 2026, there would be a 21% reduction in the monthly benefit because of the trust fund depletion concerns that Steve had mentioned earlier. So even with those two assumptions, higher interest rates and a reduction in your monthly benefit, we still found that delaying claiming to age 70 benefits most women in that healthy, wealthy group. Now, the numbers are not as impressive, of course, but you still get a benefit of about $5,000 to $15,000 per year for women in the highest earnings groups. And even for women of average health, we found that that was still a monthly benefit was still earned by delaying claiming. An interesting note, though, is as interest rates start to rise, delaying claiming becomes less beneficial for men. So particularly men of average health. So as interest rates start to go up, we want to take a second look at men because of the shorter life expectancies that maybe they shouldn't delay claiming all the way to 70, maybe delaying claiming after 62, but somewhere between 62 and 70 might be in their best interest. All right, and the next slide, so this is just sort of summarizing what we found is that women benefit the most from delayed claiming. Now, as we work with couples, one of the reasons that women end up claiming at age 62, even when you tell them that it's in their best interest to delay until 70, is because they're afraid about relying on their other assets, right? They want to retire at 62 or 65, and there's a fear for many clients that they don't want to spend down their other assets. They may have nothing left, right, by the time they get to age 70. Well, we found research from Meyer and Richtenstein about 10 years ago, they did, that actually proved that the opposite was true. They looked at a portfolio of $700,000 and they found that by delaying claiming to age 70, that portfolio's longevity was actually increased by 10 years. And there was two main reasons for that. The first is that because we had higher Social Security payments starting at age 70, we had to rely less on the portfolio after age 70 because you could get more out of your Social Security payments. So that allowed the portfolio then to stretch out for longer once we hit age 70. So we had accelerated spend down from the portfolio in the beginning, but then less reliance on the portfolio later. So that allowed it to live for longer. And then the taxation period also was compressed. This was actually the more significant factor, because if we start claiming at age 62, we're paying taxes on that income over a longer time period compared to paying taxes at age 70. Now, of course, the tax amount is going to be higher if you delay claiming until 70, but it's over a shorter remaining life expectancy. So the reduction in the amount of tax that was owed actually allowed that portfolio to last for longer. So we got 10 more years out of our portfolio by delaying claiming to age 70. And that Meyer and Richtenstein research was relying on a 4% annual consumption rate, that 4% drawdown rule over a 30-year period. So of course, as those factors change, the longevity of the portfolio will change as well. And then on the next slide here, oops, I think we go back to Steve. Yep, so Steve will talk now about some tax strategies.
Yeah, Sophia just talked about the fact that you wait to pay taxes if you wait to elect, but it's even more complex than that. Unfortunately, it's very complex, even for the middle class. So we're not talking about, very wealthy people and all the strategies we can do from that standpoint. Even for the middle class, it's a big issue. For middle class people, the issue is what's called the Social Security tax torpedo. That's what people in the industry call it. Basically, bad planning can cause every new dollar of income for a middle class retiree to be subject to an effective tax rate that's in the excess of the top marginal tax rate of 37%. How's that work? Well, what happened? First of all, what's the effect of that? When a couple is barely getting by in retirement, they're middle class and they're living, on some IRA and Social Security benefits, it can be devastating. The more that goes to the government, the less that remains for them to spend, and the less that goes to survivor. Well, the good news is you can plan around this. In other words, what happens is you get hit with a Social Security tax as you hit these different strata. That can go anywhere from being taxed on 0% of your Social Security payment to 85% of it being taxed. And so you're trying to avoid that. The way you can do that, the basic strategy is to first do what Sophia was talking about, and it's counterintuitive, but you draw down your savings, you draw down your IRAs first, and so that you can have income to live on, so you're not, living in your car and eating cat food. But then you delay filing for Social Security as long as possible. This avoids the tax torpedo during those years, because what's happening is you're not taking Social Security, so you don't have to worry about the fact that you're pushing yourself into a higher marginal tax bracket and having to pay this extra tax on it. So it lessens the tax. Also, you've now started to eat up your savings and your Social Security, so you have less to be taxed on anyway. So to pull this off, what that really means, especially for people in the middle class, but also affluent people, is you need some kind of bridging strategy to delay filing. I mean, if you're going to retire at 62, but you don't want to file, what are you going to live on? Whether you're middle class or affluent. Well, there's lots of examples. So again, you can pull down your IRAs. But there are other things you can think about, like home equity. Tapping into a reverse mortgage is a great way to do it. And maybe you do it on the kind of reverse mortgage where it pays during that period between age 62 and 70, as an example. Or withdrawals from life insurance cash values, because those are not subject to tax, because they're on a FIFO basis. And so that means you're pulling in money to help pay for your retirement, but that does not go into your provisional income calculation. I'll give you another one, just to make it personal. When I left my employer at the time at age 62, I had a non-qualified deferred compensation benefit. So what I did is I elected to have that paid over a 6-year period. The idea being that would be a bridge in case I needed Social Security, which I didn't, but still it was nice to have that, is it provided that bridge so that I could delay electing my Social Security benefit, if that makes sense. Okay, so let me go on to our next slide. Okay, so for those making more than the 44,000 married filing jointly, that leads up to your Social Security being subject, 85% of your Social Security being subject to taxation. You want to figure that it's about 85% of your Social Security will be taxed above this amount. So for affluent and high net worth individuals, the real issue is whether Social Security is longevity insurance or just an investment that you look at from a break-even point. In other words, do you look at it and say, well, how long do I have to live such that it's worth it for me to delay filing for Social Security? And that's some of the things that Sophia was talking about. But I'd argue that even for all but the ultra high net worth individual, this should be looked at as longevity insurance, because you tell me when you're going to die, I'll tell you what to buy. But the trouble is we don't know how long we're going to live. And some of the data that you saw from Sophia are somewhat shocking. Either way, that's what you should be considering in thinking through the process. Now, there's another consideration, just the human factor of things like diminished capacity. So can you talk about that, Sophia?
Sure. So we could never talk about, planning for retirees without also considering vulnerability, right, of our elderly populations. And Social Security has some built-in protections as well as other things that we can do to help mitigate that risk as individuals start becoming older and some exhibiting signs of diminished capacity. In fact, one of the colleagues that I worked with on the research, Michael Finca, has also published other research that shows that it's as people start to exhibit signs of dementia or cognitive decline that might be maybe in their late 70s, early 80s, they're still sitting on a pretty significant amount of assets, right, that they may have accumulated for retirement. So you may have individuals that are making decisions, making financial decisions. They may start to make poor financial decisions because of cognitive decline, because of maybe dementia setting in, but they could also have access to over $1 million, couple $1 million in assets. So we have this vulnerable population then that we need to maybe institute some protections for. Now, for Social Security, because it's a fixed amount, some planners recommend using that amount for critical or necessary expenses, like using them for long-term care premiums so that we make sure that those remain in effect, for rent, medications, things like that. So we know that those costs are covered by the payment, and then other costs can be covered by more variable sources of income. And then there's also Part B Medicare premiums that can be paid directly out of the Social Security payment. One thing to remember, though, is that if someone retired at, say, age 62, or they started paying their Medicare premiums already by that point, we have to remember to elect, if we're delaying to age 70, to have those premiums paid out of the payment. So many people may overlook that because they're already paying the Medicare premiums and they forget to have it elected out of to have it taken out of their Social Security payments. And then, of course, the cost of living inflation protection is a built-in benefit. We don't see that with many other retirement income vehicles. That's why Social Security is so critical for that longevity protection, because no matter what the adjustment is, that's going to be built into our monthly benefit. And we know recently, because of that 6% increase, that's become pretty substantial. Now, the program on the next slide, the SSA, the Social Security Administration, has also some built-in protections to help the vulnerable populations. The first is that, of course, direct deposit. Not only is it convenient, it's also safer, right? Because we don't have risk of loss of the check or the monthly, the cash payments. That doesn't happen. It gets put right into the bank account where it's somewhat protected. And then there's also the representative payee program. The Social Security Administration actually doesn't recognize powers of attorney. So if someone wanted to manage the Social Security payments on behalf of someone else, they have to do that through the representative payee program. The claimant must go into the system and actually identify who they would like to name as their representative payee. They can name up to 3 either individuals or institutions. So if they're in a facility, the facility can manage the payments for them. If they're in a nursing home, for example, they can do that. The SSA then reviews the information about each representative payee and they approve them to be able to manage the payments on behalf of the claimant. You have to do this though before the claimant loses capacity. So that really should be done as early as possible. And then if all goes well, the representative payee then can manage the payments for them. They do have to provide an accounting to the administration about what they did with the payments. So there's a level of transparency and protection there on behalf of the claimant. But again, it's important to do that before the person already starts to lose capacity, because then we lose the ability to do that. And by doing that, we make sure that those payments are protected. And then we'll move to Steve on the next slide to talk about some just practical planning tips for when a claimant passes away.
Yeah, just some practitioner issues. And by the way, to what Sophia was talking about there, the nice thing is when you go through the process of getting Social Security, that's where you can actually tell them who you'd like to have as representative payees. So you can help your client with that because they might otherwise just blow that off. So just some practical issues to kind of wrap it up. And then I've looked at a few of the questions and we have some good questions to talk about. So we'll do that. Is realize that the fraud is a big issue, obviously, for elderly people. And so there are ways to deal with this. I recently had a very close friend of mine die suddenly in a kayak accident, certainly not at the age he expected to, and I knew his family. And so these were some of the things that we talked about just because they didn't necessarily think about it. And I bring it up to you as estate planners that you want to be considering this. First of all, it is crucial that the Social Security Administration be notified right away, because where a lot of the fraud happens is right after someone dies and they try to do essentially steal their identity. So the easiest way is to coordinate with the funeral home. Most of them are very good at this, but I put the number on the screen that you can call to make sure that you turn that off as quick as possible. Also, just some practical things that relate to this is like in the obituary, if you wonder why you don't see dates of birth, maiden names, addresses, well, it's because of the fraud issues. So you see some of these flowing, wonderful obituaries people want written. I would just suggest that maybe you in the funeral home can kind of convince people that because of the unfortunate circumstances that we are in with fraud, that you don't do that. And then just some practical things of notifying credit bureaus quickly, because the fraud happens very fast. Notifying the Department of Motor Vehicles, those kind of things really can be something you can do to help them as an estate planner. So I believe at this point, yes, is when I'm supposed to give you the second most important information, which is the second CPE. That number is 8229. So it's 8229. And so where I want to just finish up with, as I said, the new Social Security statements are coming. Really, they're here, I think, for almost all Americans. If you haven't seen them, look at them. They went from 4 pages to 2 pages. They're much clearer. They do just a really good job, but you need to, if you're working with your clients on this, you want to look at it because, for example, they don't now automatically give you your earnings history. You have to click on. No big deal, but be aware of that. But where we were going with this, Sophia and I, in discussing how this is an estate planning issue, is that you can help them with those filing decisions that Sophia talked about. You can coordinate with other advisors on making this all happen, the avoiding fraud, particularly at the time of death, but also the whole idea of diminished capacity is important to an estate planner. So I want to thank you for the opportunity. We mentioned earlier that we have some articles, both the academic article that Sophia mentioned. I'm working on one with Dr. Wade Fallon that you'll be seeing hopefully soon as well. Also, I have an article in Forbes and Kiplinger on some of these issues, and we've attached that. So what I thought I would do is turn this over to Elizabeth, and I think that's who's going to tell us some of the questions. I did cheat and look a little bit, but why don't you go ahead and tell us what questions we should be answering.
Sure. I'm going to read the first question, which is looking for details on using current low interest rate, in quotes. We're using cash/risk-free rate or some sort of investment rate of return. I think they're asking, should we be using a cash risk-free rate or some sort of investment rate of return?
Right. So I believe we looked at the risk-free rate in the research. It actually talks about the different variables that we use there. And again, we played around with those numbers as well.
All right. The next question is, what are the assumptions used in the Social Security calculations for the delay of benefits to age 70? Also, where did the mortality statistics come from? U.S. Census?
Well, I can answer most of that. This really explains why delaying is so beneficial. The reason it's so beneficial and why it goes up 8% each year is because, number one, they are using a 3% interest rate assumption. Well, that is actually very high in the current market. I know we got inflation hitting us right now, but I mean, that is so much more than the net amount that insurance companies are crediting to their portfolios, to their clients. So you got 3%. The second goes to the question about mortality. I don't know where they're actually sourcing that, but I do know that the mortality they're using is old mortality. So for example, RMD mortality, longevity rates just changed in January. They assume you're living longer. Social Security figures still assume old mortality, and the worse the mortality, that means they're assuming you're going to die sooner, and because of that, they can give you better rates, and that's why you have this 8% increase in each year. And so we did some calculations to say, could we go out into the commercial market and buy an annuity and replace the difference between 62 and 70? And the answer is no way in the world. There is no way you can come up with a comparable annuity that would replace that lost benefit. So Sophia, do you know anything about the actual source of where that's coming from?
At least in our research, we used the tables from the SSA. And then we also, as far as the factors that we used with the longevity, we really focused on using the assumption that the woman lives longer, as well as she has her own earnings history. And we actually had different, we ran the range of earnings as well to see, that's where we got that range from, the 130,000 to the 180. So we were looking at, those two important things, the longer lifespan, as well as the woman having essentially a high earnings potential.
Great, thank you. I've seen the calculation of the interpolated interest rate of delayed claiming to be as high as 8%. Do you see it the same way?
It is 8%. It's what, 5/9 of, it's done on a monthly, but it's the effect of 8% simple, not 8% compounded. So if you look from 62 to 70, it's 8% per year, not compounded. But remember, the cost of living is factored into that.
Great. How to obtain a rep payee after client has lost capacity? How do you obtain the rep payee?
I mean, what you could do after a client has lost capacity, you could actually approach a court about receiving guardianship for that person. That's really your only recourse at that point. You would have to have the person declared as essentially incapacitated or incompetent, and then have the courts appoint a guardian for that individual.
Agree, because the power of attorney is going to be ignored. And so that's the only way. And what they do is they actually kind of panel, they look at the recommendations, but you're going to need a court to, somebody's going to have to file for that person.
Right.
Thank you. Next question is the ability to appeal Medicare premium based on unusual income event. Historically, they would reconsider and seem to deny in recent requests.
Yes. So what that refers to, and again, I suffered the Irma tax, so I'm very familiar with that. A good friend of mine was a professor. The first year they were going off of his W-2 for 2 years ago. By the way, it's not always 2 years. Sometimes they look at 1 year ago, and you can go in and say, yes, but my circumstances change. In his case, and it's easy to file, that part's not hard. You can file and say, look, my circumstances change. In his case, it did change. I have heard anecdotally, and maybe Sophia's heard something too, that they have pushed back more on granting that Irma relief. That's really what it is. Kind of like they've gotten tougher with Social Security disability claims. I'm not sure how to quantify that, but I have heard anecdotally that they're not as friendly about those appeals.
Okay. Next question is how your income earning spouse with an age of 75 or lower life expectancy, other spouse has age 90 life expectancy and she makes slightly less. Wouldn't those factors indicate that lower life expectancy spouse should take as early as possible and then other spouse delays as long as possible?
That's correct. Right. So if you've got a spouse who is not of average health, right? If you have someone who has got health problems, then you do want to actually claim earlier. So our assumptions only hold true if we're looking at that healthiest bucket. But as soon as one of the spouses is essentially not healthy and they may not live to the average life expectancy, and there's even just a risk of that, then you want to start claiming earlier because you don't want to lose out on that potential benefit. The other spouse can delay, but you don't want to lose that first spouse. So even if it's the higher earning spouse, if the life expectancy is shorter, you do want to claim earlier.
Great, thank you. And actually, I will just pose a question. Is there any current legislation pending proposed to change Social Security?
There's plenty of pending legislation. None of it actually currently has legs. This is an opinion, but what was being proposed by candidate Biden was essentially to keep the cap where it is, like it's $147,000 this year. But once you got to $400,000 married filing jointly, to reinstitute the 6.2 FICA tax, which if you think about it is kind of like free money because the people wouldn't need the benefit if they're making that kind of income. That has not gone anywhere. There has been talk about actually improving benefits, but I just don't think there's legs for that. As I mentioned, you could see something a little more quiet, like a change in the COL factors that are used to chain type of approach. But I guess the best answer that we know is with all that else that's going on in Congress, fill in the blank, there isn't anything that seems to be around the corner. It's not tied into the Secure 2.0. So it's probably going to have to take care of itself. And most of us think the earliest we'd see something is late this year, and that's wishful thinking.
Wonderful. Okay. Well, thank you. Go ahead.
We also have a question in the chat. If you could check that, please.
Oh, sure. All right.
Thank you.
All righty. This question is, you claim that delaying Social Security payments will benefit you because you will delay the payment of taxes. However, when you do a claim at a higher age, say age 70, you will be taxes at on a much larger amount. Isn't that a wash?
That's a really good question. That's refers back to that research that we found, Meyer and Richtenstein, that they had done in 2010. The amount per month is higher when you delay to age 70. So the amount of taxes that you're paying per month are higher than if you had claimed at 62. But the difference is that you start paying taxes at age 62, even though it's a lower amount per month, Whereas at age 70, you're paying over a shorter remaining life expectancy. So even though the amount of tax per month is higher, or annual, but is higher, because it's paid over a shorter lifetime, it actually ended up being less than the tax that was paid when people started claiming at age 62. So it's still a higher amount at the end of the lifespan, but since it's over a shorter time frame, it ended up being a lower amount of tax.
And I can't emphasize enough the tax torpedo. If you get people in the middle income bracket, you just have to see the numbers. They are absolutely startling that you need to push off Social Security if at all possible. Otherwise, you're paying an extra tax on each dollar. So just want to emphasize that with middle income.
Great, thank you. I am going to close out the Q&A session and turn it back over to Don.
Well, thank you very much. And on behalf of the Estate Planning Council of Rochester, I'd like to thank Sophia and Steve for the nice presentation. As a small token of our appreciation for the presentation today, we have a gift card for both of you that will be mailed to you. Although I think if the cold weather continues up here, I might consider hand delivering Steve's personally to him down in Florida. Also wanted to remind everyone about our next meeting, which is coming up on March 29th, and that's on planning needs of individuals with disabilities, supplemental needs trusts, and ABLE accounts. And that's going to be presented by our own EPC members, Nicholas Prokow and James Traylor. So thank you very much for your attendance, and don't forget to fill out the evaluation forms. And for the attorneys, don't forget to also fill out the attorney affirmation forms. Thank you.
Thank you, Jamie. Great job. Thank you very much,
everyone.
Steve and Sophia.
Thanks.
Thank you very much. It was a pleasure to be here.
Wonderful.
Thanks, Sophia.
Good luck with your
everyone.
presentations later, Steve. Good luck with your
Pardon?
presentations later that you have.
Oh, good. Thank you.
Start drinking your coffee now.
Yeah, 4,000 people.
And have fun with Ed. He's a character.
He is a character.
Take care.
Thank you.
Bye-bye.
Bye.